Imagine you and your friends all want to buy a box of assorted chocolates, but none of you have enough money to buy the whole box alone. You each have a little bit of money, but it's not enough to get the variety and quantity you desire. So, what do? You decide to pool your money together. By combining your resources, you can afford the entire box and enjoy a greater selection of chocolates than you could have individually. This simple act of pooling money together to achieve a common goal is a powerful concept. It allows each person to contribute what they can and still benefit from the collective effort. This idea is not just limited to buying chocolates. It can be applied to many areas of life, including investing. This, in essence, is the basic idea behind a mutual fund. A mutual fund operates on the principle of pooling resources to achieve greater returns. Instead of investing individually, where your options might be limited by the amount of capital you have, you join forces with other investors. A mutual fund pools money from many individual investors like you and me. This collective sum is then used to invest in a diversified portfolio of assets. These assets can include stocks, bonds, or other securities. By pooling resources, investors can access a broader range of investment opportunities. This collective sum is then invested in a diversified portfolio of assets like stocks, bonds, or other securities. Diversification is key because it spreads the risk across different types of investments. If one investment doesn't perform well, others in the portfolio might do better, balancing out the overall performance. The beauty of this system is that it allows investors with smaller amounts of capital to access a wide range of investments, which they might not be able to afford individually. For example, buying shares in a high-performing company might be too expensive for a single investor, but through a mutual fund, they can still have a stake in that company. Overseeing these investments is the role of a fund manager. The fund manager is a professional who has the expertise and experience to make informed investment decisions. They analyze market trends, economic conditions, and individual securities to build and manage the fund's portfolio. Think of the fund manager as the expert chocolatier who carefully selects and combines different chocolates to create a delicious and well-balanced box. Just as the chocolatier knows which flavors complement each other, the fund manager knows which investments will work well together to achieve the best possible returns. Similarly, the fund manager uses their expertise to manage the mutual fund's portfolio, aiming to generate returns for the investors. They continuously monitor the investments and make adjustments as needed to respond to market changes and opportunities. This collective investment approach not only makes investing more accessible, but also offers the benefit of professional management. Investors can rely on the fund manager's knowledge and skills to navigate the complexities of the financial markets. This makes mutual funds an attractive option for both seasoned and novice investors. For those new to investing, mutual funds provide a way to start with a relatively small amount of money and still benefit from a diversified portfolio. For experienced investors, mutual funds offer a convenient way to diversify their investments without having to manage each one individually. Additionally, mutual funds come in various types, each with its own investment strategy and goals. Some funds focus on growth by investing in stocks of companies with high potential for appreciation. Others might focus on income by investing in bonds or dividend-paying stocks. There are also balanced funds that aim to provide a mix of growth and income. When choosing a mutual fund, it's important to consider your own financial goals, risk tolerance, and investment horizon. A financial advisor can help you understand the different options and select a fund that aligns with your objectives. In summary, mutual funds offer a way to pool resources for greater returns. They provide access to a diversified portfolio, professional management, and a range of investment options to suit different needs and goals. Whether you're just starting out or looking to expand your investment portfolio, mutual funds can be a valuable tool in your financial strategy. So, just like pooling money with friends to buy a box of chocolates, pooling your resources with other investors through a mutual fund can help you achieve your financial goals and enjoy the sweet rewards of your investments. Let's go back to our chocolate box. Imagine opening a beautifully arranged box of chocolates, each piece meticulously placed in its own section. This box represents a mutual fund. When you and your friends pool your money to buy the box, you each receive a share of the chocolates, right? Each friend gets a portion of the chocolates based on how much they contributed. This is similar to how mutual funds work. In the world of mutual funds, these shares are called units. Each unit represents a slice of the entire fund, just like each chocolate represents a part of the whole box. When you invest in a mutual fund, you are essentially buying units of that fund. These units give you a stake in the fund's portfolio, which is a collection of various investments like stocks, bonds, and other securities. The number of units you own is proportional to the amount of money you invest and the fund's current net asset value, or NAV, which we'll discuss in the next section. The NAV is crucial because it determines the price of each unit. Just like each chocolate in the box contributes to the overall taste experience, each investment in the mutual fund's portfolio contributes to its performance. The diversity of investments helps in spreading risk and potentially enhancing returns. As the value of these underlying investments rises or falls, so does the value of your mutual fund units. This fluctuation is a natural part of investing and reflects the market's movements. This concept of units simplifies the investment process for individuals. Instead of having to pick and manage individual stocks or bonds, you can invest in a mutual fund and let the fund manager handle the complexities. You don't need to buy individual stocks or bonds. You simply buy units of a mutual fund, and the fund manager takes care of the rest. The fund manager's expertise and experience are leveraged to make informed investment decisions on your behalf. This makes mutual funds an accessible and convenient option for many investors, especially those who may not have the time or knowledge to manage their own investment portfolios. By pooling resources with other investors, you gain access to a diversified portfolio that might be difficult to achieve on your own. Understanding mutual fund units is the first step in demystifying the world of mutual funds. It's important to grasp how these units work because they form the foundation of your investment in the fund. As you continue to learn about mutual funds, you'll encounter terms like a NAV, expense ratio, and portfolio turnover. Each of these elements plays a role in how your investment performs and grows over time. Investing in mutual funds can be a powerful way to achieve your financial goals, whether you're saving for retirement, a child's education, or another long-term objective. The key is to understand the basics and build from there. By starting with the concept of mutual fund units, you lay a solid foundation for your investment journey. Remember, each unit you own is a step towards your financial future. So the next time you think about investing, consider mutual funds and the simplicity they offer through units. It's a straightforward way to participate in the financial markets and work towards your financial aspirations. With this understanding, you're better equipped to make informed decisions and take control of your financial destiny. Happy investing! Now, how do you know how much your share of the chocolate box is worth? Imagine you have a box of assorted chocolates, and you want to know the value of your share in that box. This is similar to understanding the value of your investment in a mutual fund. This is where the net asset value, or NAV, comes in. NAV is a crucial metric for mutual fund investors because it provides a snapshot of the fund's per-unit market value at any given time. NAV is the per-unit market value of a mutual fund. It represents the price at which investors can buy or sell units of the fund. Understanding NAV helps you gauge the performance of your investment. It's calculated by dividing the total market value of the fund's assets by the total number of outstanding units. This calculation ensures that each unit holder knows the exact value of their investment. Think of NAV as the price tag on your box of chocolates. Just as a price tag tells you how much a box of chocolates costs, the NAV tells you the current value of each unit of the mutual fund. It tells you the current market value of your investment in the mutual fund. By keeping an eye on the NAV, you can understand how your investment is performing over time. NAV is calculated at the end of each trading day and reflects the changing values of the underlying securities in the fund's portfolio. This daily calculation ensures that the NAV is up to date and accurate. Monitoring the NAV of your mutual fund helps you track its performance and make informed investment decisions. By regularly checking the NAV, you can decide whether to buy more units, hold on to your current investment, or sell some units. Remember, just like the price of chocolates can fluctuate, so can the NAV of a mutual fund. The value of the underlying assets in the fund's portfolio can go up or down, affecting the NAV. Therefore, it's important to stay informed and understand the factors that influence these changes. Diversification is one such factor. A well-diversified mutual fund can help mitigate risks and provide more stable returns. By spreading investments across various asset classes, sectors, and geographies, the fund can better withstand market volatility. Market trends and economic conditions also play a significant role in determining the NAV. Staying updated with financial news and market analysis can give you insights into potential changes in the NAV. Reviewing the historical performance of a mutual fund can provide valuable context. By looking at past NAV trends, you can identify patterns and make more informed predictions about future performance. Setting clear financial goals is essential. Whether you're saving for retirement, a child's education, or a major purchase, understanding the NAV and how it aligns with your goals can help you stay on track. Working with a financial advisor can also be beneficial. They can help you interpret NAV data, develop a personalized investment strategy, and make adjustments as needed to achieve your financial objectives. In conclusion, the NAV is a vital tool for mutual fund investors. By understanding and monitoring it, you can make informed decisions, track your investment's performance, and work towards achieving your financial goals with confidence. One of the most significant advantages of mutual funds is their accessibility to investors with limited capital. You don't need a fortune to start investing. With mutual funds, you can begin with relatively small amounts and gradually increase your investment as your financial capacity grows. This low entry barrier makes mutual funds an excellent option for young adults, new investors, or anyone looking to dip their toes into the investment world without committing large sums of money up front. Furthermore, mutual funds offer a level of diversification that is often difficult to achieve with individual stock picking, especially for small investors. This inherent diversification helps mitigate risk and potentially enhances returns over the long term.